The bond market is sending a warning to rates, and most people aren't paying attention.
Normally, when rates are cut, borrowing gets cheaper across the economy.
Most of the time, long-term rates follow those cuts. But this time, long-term rates refuse to fall. But this time, long-term rates refuse to fall. Investors are pushing back by selling government bonds. When investors do this, they're often called bond vigilantes. Higher long-term yields raise mortgage rates.
They also raise borrowing costs for businesses. When borrowing gets expensive, growth slows.
We've seen this pattern before, Taos, especially in the 1970s.
Back then, rate cuts failed to stimulate the economy.
Rising long-term yields eventually triggered downturns. So why are investors selling bonds now?
Unlike the 1970s, inflation is trending down. Commodity prices tell the same story. What changed is government debt.
Debt has surged dramatically over the last few years.
When debt grows too fast, confidence weakens.
Countries with higher debt usually face higher interest rates. This suggests rates may stay elevated longer than before. That doesn't mean yields will spiral higher. Markets prefer stability more than low rates.
When rates stabilize, some stocks quietly perform very well.
Understanding this gives investors a real edge.
It helps protect against downside before it shows up.
It helps protect against downside before it shows up.
And it shows where opportunity is building. The setup for 2026 is already taking shape. And it shows where opportunity is building. The bond market always sets the tone. Watch the bond market. It tells the story before everything else does. We break down what actually moves markets. Subscribe if you want clarity, not noise.